Hello, this is Teddy Keckstedt from Forex Trading Unlocked, and today we have a webinar that is dedicated to candlestick patterns. Most of you who are familiar with technical analysis, the charts that you most likely look at for the most part are Japanese candlestick bars, where it shows the body of trading as well as up or down, and it's very visually different than a normal typical bar chart, our Western bar chart. And over the past 20 to 30 years, actually, in my career, it's gone from bar charts to candlestick charts. Even if you look on normal websites like Yahoo and Google for finance, the charts that you see will be in candlestick format. And so with that, we're going to move on real quick and cover some quick accounting and let you know that this webinar is for illustrative purposes, and we're going to teach you about all kinds of patterns and actually show you some patterns that are going on in the markets right now and how you can capitalize off of them and how integrate them into your trading strategies. But this is all for illustrative purposes, and so that's what our disclaimer is for. And with that, we are going to go to our live scene now, and here we are. We are at the www.forex-trading-unlock.com website. And today we are going to identify a bunch of patterns, targets, risk levels, and what trades are there for Forex, futures, equities, and options traders. And we're also going to show you when things fail. These things are not 100%. But they do help you to increase your odds for trading different markets, whether it's correlated trades or the individual markets themselves. And we'll get into the correlated trades later as we get into the webinar. So first, here we are on the home page, and in our top menu bar here, we go to the Forex icon right there. We click on that, and that's going to pull up our Forex page, and this has all the major crosses and the different cross rates against them individually. But we're going to just look at the majors right now. So today we're going to cover the Euro US dollar, the New Zealand dollar US dollar, the US dollar Canadian dollar, and the US dollar Swiss franc. There are multiple signals that have recently occurred in these markets, and that's what we're going to cover. So right now, let's see where we are right here. Okay, so first of all, let's start off with the Euro US dollar. This is a very popular currency cross. So of the in the dollar index, the euro and the pound equate to they're the dominant pairs versus all the other pairs that are out there against the dollar. So we're going to cover this one first since it's our number one major that we're looking at. Okay, so on our website here, when you go to the Forex page for Euro US dollar, the chart comes up. And it's also going to show you a bunch of news as well. So we'll look at that real quick to make the chart nicer and easier for our examples that we're going to look at. We're going to get rid of the volume. That's not something we're indicative of our lesson today. Now, this is currently, the market is trading. It's Sunday night, so the euro is already trading and it is down. And that actually will get into our signal that we have. So on our website here, if you come to our page, you can see that there's all kinds of news. Now, we just had the G20 meeting that just happened. So now, normally, if we were doing a webinar and doing analysis, we would look into all this news that might be pertinent or not. There are some positive fluff that's come out of the G20. I wouldn't want to say that right now we can really trade off of it. So let's go with the technical aspect, which is what this webinar is all about. So up here, we're going to click this little button here. That gets rid of the news, and now we have our chart. Okay, so now what are we looking at here? So right off the bat, we have this little red higher move high spike, and now the market has settled into a sideways and now a lower trade. Well, this day here with this higher move high, that is a Japanese candlestick pattern. So we're going to put a little arrow here to highlight this day right here. Now let's make this, we'll darken this into black. And now one thing you can notice, folks, is that this website, there's no logging in. You can come and pop on these pages and start doing analysis, and there's a little camera icon here. You can freeze some charts and email them and send them out, and you can do this whenever you want, just to let you know. So right here, this little higher move high, this here was a bearish engulfing line. So we're going to type this in here just so that as we refer back and move back to our analysis here, because over the course of this webinar we might end up referring back to this Euro US dollar chart. In fact, I'm pretty sure that we will. Okay, so this here is a bearish engulfing line. Okay, now this here happens to be a sell signal. So here, we're going to put this right here, leave this on the chart. Okay, so what does this mean? All right, now this arrow actually is probably the wrong one we should use, because we're going to have to use levels here for us to trade off of. So here, let's get rid of this. Let's see how easily we can change these things on these charts, folks. This costs you nothing. You can come on here, and anytime you just want to use it, do some analysis and figure stuff out without logging into your trading accounts, anywhere in the world you can do this. Okay, so here we have that high, the bearish engulfing line. So here we have this red sell signal right here. So what does that mean? Okay, so we've had a uptrend on the daily trend right here that has been going on since towards the end of May. It bottomed, it was going choppy, but then the last week of May pretty much, and then going into the beginning of June, this is where the market bottomed, based, and it started to set the higher move high, higher move low, higher move high, which is where this bearish engulfing line hit. And this is what we need to talk about here, folks. These candlestick patterns, whether they are buy signals or sell signals, you are not trying to pick bottoms or tops, because no trader should. However, during the course of a trend or a counter trend, a corrective move, like for instance, this market has been rallying since the end of May, and it's been going up, and here we had a lower move high, and then we had a higher move low that signaled a potential change in trend. Then boom, higher move high, higher move low, confirmation of change in trend, short-term trend. Higher move high, definitely continuing of the short term. So the short-term trend now is definitely confirmed a bull. The intermediate trend is neutral. The long-term trend is neutral to lower. So that being said, this move right now, just like here, you had the higher move high, higher move low, higher move high again. Now we have this bearish engulfing line. Here's a sell signal for a short-term correction. Now, since the short-term trend is bullish, this is a perfect time where you're looking to take profits. So let's say that you were a bull, and you have been riding this up since this lower bottoming phase, and you've been getting chopped up forever, or maybe you haven't. Maybe you caught it just in this gush right here. After you made this higher move highs, here you go, boom, it's bullish. No reason not to think the bull trend it's there. Euro strength is there, even though there is US dollar strength, but the euro is getting stronger. Not so much. Here we have the sell signal, short-term correction. Trade the action, not the reaction. Right now, we have a reaction going on here. So if you were trading the action, meaning that you were a bull, this would be a time where with this signal, if you are already up and you've made profits, this would be a good time to, at the very least, get out or raise your stops. So if you're long from down here somewhere or up in here and you've pressed it to here, I would get out. If you're long and you're long from just above or just below, where the market is right now, especially around this top, yeah, we could bobble around here. You know how tops and bottoms become support and resistance levels. That might be something that could happen. We don't know. But after the G20 meeting, with the fluff that seems to be coming out, there was no real negative news, but not necessarily positive news. So I think that just means that short term, let's see what happens between the US dollar and China and blah, 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 and each individual currency. So that being said, there's nothing with the EU and Brexit that came out of this thing, and especially with the Iran conflict that's going on. Now, you got to remember, Euro US dollar, there's the petrodollar. The US dollar is a petrodollar, so is the euro dollar. So we have to watch oil over the next couple of sessions, definitely a week or so, to figure out whether or not we're going to get some divergence of trend. That's a whole other issue. There's always uh, you look at, if you trade one market, you can trade that and focus on that, but you should always be aware of the fact that whatever underlying market you trade, there's other markets that influence or a confluence of those markets. So that being said, let's get back to our short here. So here we have the bearish engulfing line. So right here we have this. So what does that mean? Okay, well, the first thing we want to look for is some areas of a target level. So here we know that we are in a short-term bull trend. So let's just say that the bull trend is going to remain in place for, who knows, the next 2 months, 3 months, 4 months. We don't know. We don't have a crystal ball. Nobody does. And let's just say it's a corrective move, something similar to this. I mean, markets don't go in straight lines. We made a higher move high. Now it's time to set a higher move low. Was it set here on the same day? Probably not. Most likely it's going to be something like this pattern here. Is it going to be as severe? I don't know. But let's give us a guideline here also for that. So with that, we're going to put this little support line and right here. So here's our upward sloping support. Okay, folks? And then we're going to also put on this little Fibonacci real quick to find some target levels. Okay, so with that being said, we have the Fibonacci, and now we're going to get some price targets. So here's our 0.382. We'll put that line in, and then our 50%, which is one of our biggest trading levels. I don't care if you are a Forex trader, a futures trader, a stock trader. It doesn't matter what you are. Markets tend to gravitate towards a 50% level. Not that they stop there, but they are a very good target level, especially for when you're looking at long-term extreme moves, not like intraday, 15-minute, 30-minute, hourly moves. If you're looking at the weekly, daily, and things like that. Okay, so that being said, we have the Euro US dollar, we have this bearish engulfing line, and now there are multiple reasons and for getting target levels. There's all kinds of algorithmic traders out there right now. The machines are definitely dominating the trading industry. And then there's all kinds of other traders, and then you have hedge funds, and you also have hedgers that are in the market because they have businesses. You got to remember that the financial system and the markets are set up as a hedge for legitimate businesses that need to use the markets to hedge their experience in their business cycles. So that being said, with the Euro US dollar and the G20 meeting, it didn't give us any real results or anything that we need to be worried about. We're going to put on a horizontal ray. Now this high that was set the other day is going to be our risk level for shorts. And we're going to change this color here and set this chart up. And then we're going to start to show how to trade this pattern. And this is looking good here. Okay, so right now we have this current high, and then we have the bearish engulfing line. This all occurred on this single day right here. So now it's kind of funny, when you normally have a pattern like this, you would have maybe a reaction like this the following day, and maybe even the second day, but not where the market settles basically unchanged for 2 days, where it actually had kind of a range. But look at how this market set us a higher move high, and this is a bearish engulfing line, and that means that the body of this day engulfed the whole body of this day before, and that's why this is a turning point. Now, for those of you that are familiar with classical bar charting, there's the classical reversal signal. The bearish engulfing line falls in line with that type of signal in the classical Western technical analysis philosophy. However, it also means that in this one here, which is Eastern, it not only makes a higher move high and engulfs the whole body, it settles lower. It settles below the opening of that prior move high, or high day, which it superseded its high and then settled below its opening. So this is where it's not just profit taking. This is where you're looking at the move is exhausted. Like, this is a gusher. So folks, look at this. The market had moved up, it's been railing, and then look at this extreme buy days, and then even this high. The next day it rallies, makes new highs, and then settles lower. This is an exhaustion point. I mean, you can think about this in a physical reality. There's multiple examples you can use, whether it's sports or whatever in life, and it's just a matter of a rubber band effect. There's so much momentum pushing it to where even if it's going to keep going higher, it needs to let off some air, let something pocket out and let it gush out. And now the funny thing is we were heading into the G20 meeting, so we had these sideways days. Like, it's not, these are dojis here for candlestick chart people. Since we're on a candlestick lesson here. So here we have the bearish engulfing line pattern right here. Bam, sell signal. Look what happens the next day. Slightly positive, kind of trades in the range, 50% down, doesn't make a newer move low, doesn't look like it wants to press new lows, but then could be digesting, settle on it. Now, if there wasn't the G20 meeting, you would think, oh, next day we should see some action. No, next day, same thing, even contained inside that day's range. Then, boom, Friday, boom. We have a little bit outside there, but still basically unchanged. The markets just settled down, and they were quiet, waiting for the world leaders to talk or figure something out that nothing we know did happen. And that's why I think that this sell signal that happened here, 1, 2, 3, 4 sessions ago, now, boom, because here was this close, that was where the short was right there the next day. It's finally positive. It was taking heat. It was up heat and then slightly positive, slightly negative. Here we go. We're wondering how the weekend's going to go. The Forex markets are closed over the weekend. Here we had this big geopolitical meeting. And now, bam, today it's lower. I was talking to some people earlier this week, this weekend about, is the market going to gap higher and then maybe sell off and they have like a head fake or whatever. I'm like, I don't know. None of us do know. I have a sell signal that's been going on for days, and I have to just stick with my plan. So if you read my book, Probable Japanese Candlestick Patterns, which is the 3rd year anniversary this week, and it's on Amazon. You can get it in a Kindle version or in paperback version. And for a signal like this, I give you target levels and projections for where the market most likely will gravitate to. And now the one thing I can tell you is that from a signal like this is a sell signal. So a bearish engulfing line, this high right here, 114.11, that's your risk right there. So if you want to get on the bandwagon with a signal like this, a sell signal, this would be your risk. So like on this day when it closed, the close was 113.66. That afternoon when it rolled into the new time sequence for the following day, you're selling around 113.66. Your risk level is 114.11. So that is, not exactly a small amount of risk, but then considering what the euro-US dollar trades in, we're not looking at an intraday trade. We're looking at a daily trade, which has to manifest over the course of days, meaning upwards of a week. It could be 2 weeks, who knows? So, and that being said, that's your risk level. So now think about this. So here you have basically a half a dollar risk level. And now our first target level right here is your pivot here at 113.23. Now, according to my methodology, when you use this type of sell signal, it's more actually towards this 50% area, which is at 112.95. So now 112.95, let's just use 113 even for easy math. So the market right now is currently at 113.48. Our initial sell signal from this candlestick pattern was 113.65. So if 113.65 is your target, or your initial sell area, and 112.94 is your target objective, you're looking at basically 70 pips in the Forex market or 70 ticks in the futures market. So 70 ticks, and then what was your risk? Your risk was 1366, so 50. So it's basically 1.5 to 1. Usually for trades like this, in my book, It's very systematic as far as how you execute trades for the Forex market, the futures market, or options market. And I look for at least a 2-to-1 ratio for risk reward. So this is a kind of signal where, now you got to remember, we're looking at the euro US dollar. If it was 4 years ago, we would be looking at a trade that most likely we would have the risk reward ratio and the numbers, we wouldn't even be questioning it. But this market's been trading in a $3 to $5 range for 6 to 8 months, so which is not normal for currencies, especially one of the major currencies against the dollar. So that being said, there's also this 112.69 level. Now 112.69, that's a different story. Now, if you read my book, this area right here, it comes actually right just piercing below this 50% level. So it's not quite the 2-to-1 ratio, and it's also you're going counter trend. So that this would be a signal where this is up to you. It most likely, I mean, right now, obviously, finally, after going into this meeting, going sideways for, I mean, think about this, folks. Like, this signal happened, it looked good. Then 1, 2, 3 days, you had Friday, Thursday, Wednesday of trading going into the weekend G20 meeting where you were sitting there. Oh my gosh, I have my stop here above the high, and even in my methodology, it is very pertinent that you stick to the plan. And the plan means that if the trade does not start to surface after 5-6 days, to get out of it, whether it's a small winner or a small loser, because you're looking for it to happen over X amount of time frame, or, well, depending on if it's daily, weekly, or monthly. These are things we cover in the book. But yeah, like this signal, it happened was, let's see, we are on Sunday night right now. You're looking at 4 sessions ago. By sometime between tonight or Monday or Tuesday, it should hit this level. If it hasn't hit that level, you would be getting out of this trade, or definitely if you were remotely profitable, putting in a break-even stop. So right now it's pretty tight from where we entered this from the sell signal to now. So you wouldn't be lowering your stops yet, even though you'd be slightly positive. Finally, you'd be sitting on this for yet another couple days. So we will see what happens over the next course of the next few sessions. We don't know what's going to happen, most likely. I think that because of the sell signal that we are looking for a break down into these lower 2 yellow lines. And then look at, we have this upward sloping support here. So right here, this 112.69 level, it's not out of the realm of possibility that we could have a break. And here we'll put this right here as a target range right here. From here to here and there. Okay, so this one right here, let's change these colors so it makes it a little bit easier for you to see. Now look at this, how you can do this on this website, folks. Very easy, very transparent. So this is our target range into here. And right here, this lower pivot, right here with this upward sloping support. Now, if this is classical bar charting and technical analysis, we have a short-term change in trend. We had a higher move high, higher move low, higher move high with this bearish engulfing line. Right now, we're not looking for a bearish change in trend. All we are looking for is a bearish short-term move. Correction. It's a short-term corrective move. That would mean that if this sell signal is right, it puts the market down into our target range right here. Now, where will it stop? I don't know. We'll see. But right now, it looks like that this is pretty much the area where we should see the market gravitate to. So this is the Euro US dollar. Now, we have a lot of US dollar strength that has come into the marketplace. Right now, as far as Euro strength, I think that the reason we've seen this short-term intermediate upside trading with the Euro US dollar is because there's been so much pessimism on the Euro, not the US dollar. There's been pessimism on the US dollar, and obviously US dollar strength has been bullying its way, or bullishly running away with things. The Euro strength, I think, comes from the fact that everything's been downplayed. The Eurozone, in the midst of possibly having a hard or soft Brexit, things have been kind of tossed up. There's a little divergence of currencies with different crosses that are related to the Eurozone and the UK. We know that there's nothing that's going to happen until October 31st. The reality is they keep projecting negative economic forecasts for production and all kinds of things throughout the EU and the UK because of U.S. trade wars and whatever, but numbers keep getting beaten. So when you lower expectations, either they're lowering expectations so far that even if things are falling, they look good, or they're lowering expectations in the presence of strength, which then that's why we have the euro where it's at. And I think that's really why it is where it's at, because it's been basically in a $5 range for the past 6 months. Even if it was to all of a sudden start sliding and get back down to 109, 109.5, I think 109.5 to 108.5 would be the extreme for any major slide. And then if it did get down there, that's when the U.S. dollar, even if it's somewhat strong, that's where corrective profit taking would come in. Let alone, I just don't think the euro is that weak. The only thing that would solidify a break down into that area and actually enhance a trend that would be continued would be that there is actually strife in the EU, where there's all kinds of economic dismay with PPI and CPI and all kinds of economic numbers that are not just in Germany, which is the core of the EU, but also all the other countries, and maybe you have issues with Spain and Italy and Greece, and that starts to become to the forefront again. And if all this explodes, then that would be the perfect storm to make something like this happen. So that being said, we have a bearish engulfing line. Here's our signal. There's our target area. There's our risk. So even if you were to risk right now, you're looking at 60 cents to make, well, there you got 13.5. I'm sorry, right now, 113.5 down to 112.95. It's pretty much a 1-to-1 ratio right now for risk reward. But at least you know that right here, this is it, because any rally above here means higher move highs. Even if it just pops above it and then falls around and changes trend, that's where you definitely do not want to be long. So short term, once again, we have our sell signal for the bears. Here it is. This is our bearish engulfing line right here. 114.11 is our risk, and this is our target zone. Okay, so now with that, we're going to pull up a new chart, and we're going to go to forextradingalike.com, and it's going to pull up our home page, and now we're going to get some new charts. Here we go. So we're going to click on the Forex icon, because we're going to refer back to some of these charts as we get through this webinar. All right, we're going to close down the social media thing here, and let's go to our US dollar CHF. Okay, so on 625. Okay, here we go. So the chart is loading right now. We'll get rid of the social media stuff. We don't have any questions from any viewers. So here on our website, anytime you pull up these charts, you're going to get the charts. You're going to get all kinds of news and technical analysis. We're going to close out the news right now because this is all about just technical analysis and patterns. So what do we have here? We have the US dollar CHF. And what do we have? We have a buy signal. So now a buy signal here is right with this brand new stamped low that was put a couple sessions ago. And now this means that US dollar strength is coming into the market. So what do we have here? We have a piercing line. Buy signal. Okay, there we go. Okay, so here we go. The piercing line buy signal. So what does that mean? We have a gap higher this morning or this evening, wherever you are in the world. The G20 summit has happened. Obviously, US dollar strength is in the market right here. So real quick, we're going to look back at the Euro US dollar. Euro is going down. Euro weakness, US dollar strength. So that helps us with our US dollar CHF with Swiss trade. So That being said, we have this piercing line buy signal. Okay, so that right there targets this level right here. Okay, so we have a market that has been trading lower intraday and daily for the past couple months, setting lower move lows, lower move highs, keeping on going, boom, boom, boom. And then with this piercing line buy signal, still made a lower move low after an extreme sell-off. I mean, look at this. In 1, 2, 3, 4, 5 sessions, the market went from parity down to 97. That's a $3 move just in that amount of sessions. And then we have from here, from a buck 2 down to 99. That took what? That took a month and a half. So as the market was trending lower, bam, slams almost the whole amount of that move within just a week and a half. And now here we have a gap higher, and boom, piercing buy signal. What does that mean? Okay, well, if you read the book, High Probable Japanese Candlestick Patterns, there's an exact target equation for how this signal works. But right here, one of our targets we would look for with just this signal alone for a normal methodology of analysis is this last lower move low, because that's where resistance is going to be found. So this is right here our level to look for bullish strength. Is it going to happen? I don't know. We'll see. But for our buy signal right here, this here targets this area right here, and right here you had the piercing line, so that meant on the following day at this close, which would be in that afternoon, that would be when you would have been buying the market, and your risk would be the low right here. So that low is not a big deal. I mean, look at the close here. We have the close is at 97.54, and the low of that day is 96.93. So you're looking at a $0.50 move. $0.50 actually is a little bit of risk there. However, we don't want to catch a falling knife, but with this kind of signal, this would be where you would be, you know what, the next day, let's risk that low and see what we can do with it. And that following day, bam, we had a nice little rally. Oh, but then look, markets rallied and fell apart, and here we had this. That was Friday. Well, but what did you have there? You had a lower move low and a lower move high. Still bearish, very bearish, but the piercing line buy signal. And that's where these signals come into place, folks. Putting the odds in your favor. Like, there's times where, let's say that you had been short the whole time, this US dollar Swiss. Like, you don't need to catch a falling knife here and just say, hey, a piercing line signal jumps out at me, let's buy this market. This could be a failure too. However, let's say that you were on the short side and you've been riding this down for the past few months, whether you were short the Forex currency, or let's say you were short the futures and you just recently rolled from the June to September. If you'd recently rolled from June to September, after what happened here on this little session right here, that's where I would say, you know what, it's time to cut out of that contract and let's wait for a rally to sell. Let's look to sell higher, take some profits, you know. And then there's also the currency trade for the Forex market, depending on, excuse me, the swap rate. Sometimes that's indicative of whether or not you will take a trade. That's not what this lesson's about. This right now is just about direction and buy and sell signals. So right here, not trying to catch a falling knife, we had this buy signal. So if you were short, this would be a great time to say, you know what, I don't need, pigs get fat, hogs get slaughtered. Time to take some profits, at least cut back on your position. Now, does that mean to reverse it? Absolutely not. Now, if you didn't have a position and you were looking for trying to find a trade to fade and try the correction, since right now you can't, if the market, like right now, is railing, you can look for an area to sell. This might be an area to sell right here. But right now, since there was this buy signal, it's bullish. And I think right now you got to look towards this area right here. We're not going to divulge our methodology for targets because you have to read the book, High Probable Japanese Candlestick Patterns, available on Amazon on Kindle and paperback, which is on its 3rd year anniversary. And after this webinar, we will be reducing the prices soon just because it's an anniversary. So here we go. Right now we're looking for a challenge of this area right here. So we're going to give a little elliptical spot right here, and we're going to put this across here, and we're going to put it right into there. So this right here is where we're looking for the market to pretty much be exhausted. Now, does that mean that this could be, now, when it comes to these patterns, something to take into account is sometimes they just are the beginning of a corrective move, like right now, which is shaping out to be. The market could continue lower over the next few months, the next few years. This could still be the middle of a major wave down. However, a lot of times when you have signals such as the piercing line buy signal, and there's all kinds of sell signals, whether it's rallying into a sell signal or breaking into a buy signal, when you have a Japanese candlestick pattern that stamps that high or that low, meaning that after time that holds, that is usually the beginning of a new trend. Now, since the market has been trending lower, does that mean it's going to become a bull? No. It could be the beginning of a basing period and sideways range trade. So it doesn't necessarily mean that the market's bottom and now, hey, buy it and get long and hang on to it for the next 6 to 7 months. No, by no means. It could be, this may be, absolutely. It could be the lowest low for recently, it was a few sessions back, for the next 2 years. Who knows? We don't know. But that's not how you want to look at it. You want to look at it in the short-term basis. This is a daily chart. You're looking for a daily move. You're looking for, after this happened here, this is your risk down here, and this is your target area right there. Could it go higher? Absolutely. Everyone has their methodologies, their systems, and what have you. We're just trying to give you ways of finding buy and sell patterns that will give you increased odds of trading in the markets. And one thing you can look at this is, besides, let's just say we were talking about rollover, the US dollar Swiss also has the futures contract that just expired. So right now you would be looking to be long the September contract, but you could also, at this time when this happened here, because of the G20 meeting, so here we're looking at Sunday. This is already Sunday night, and it's gravitating to this. Unless we were long since last week and sitting on this and sweating it out, well, there's no money to have been made. But however, what happens if once this pattern had been finished, that following day you were a futures trader and you sold credit spreads below this low? I mean, seriously, right now you're looking at multiple days of time decay, and now it's going further and further in the direction that you want it to go, away from your credit spread. In the midst of a meeting like that, talk about free money. Just the time decay alone, you put the position on, you get out of it, you knew what your risk was. I wouldn't say it's a license to print money, but for sure, unlike the outright Forex traders or futures traders, you have nothing to it. You would not have gained very much unless you were on the right side of this position, or the right side of the swap, which would be indicative of the actual Forex trader. So that being said, let's go back to the Forex markets page, and here we go. We're going to go now to the Canada. So what's going on with the US dollar Canada? All right. We have no questions on the chat so far. So we're going to close this out right here for the social tab, and let's see what we have here. Okay, so far we've covered the Euro US dollar, the US dollar Swiss, and now we're looking at the US dollar Canada. Okay. So we're going to get rid of the volume right here. Okay. So right here, we had the market that was breaking, and then it rallied up here. Once again, we have a bearish engulfing signal. Now, granted, these signals that we're showing you obviously happened in the past. You're not paying for current market signals. We're trying to show you how, had you been aware of these signals, you would have opportunities in the past. So right here we have this bearish engulfing signal. Market had been breaking, then all of a sudden it rallied, counter trend, which obviously before that was neutral to higher. Here, higher move higher, lower move lower, higher move high or higher move low? No, it's, excuse me, a lower move high. Lower move high setting up, and then boom, bearish engulfing signal. Does that mean that the market's going to go down? Well, obviously it did, but this would be a point where if you were bullish or neutral or in this rally right here, this would be a great time to go to the sidelines and look at what happened. Boom, 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 very, very negative. Took out this, and that's the thing is, change in trend. Lower move low had been made, lower move high, sell signal, boom. This is the area where you would have been looking for this to easily, very easily target right here. This was a given, just a given, no matter what. And this is where signals like in the last one where it was a corrective move, just like this, sometimes is it going to be a big move? You don't know. In the euro, in this last example, it was a very narrow range trade for months. This one here, it had been grinding. Look at how it had been chopping. US dollar Canada, chopping higher, just working its way. Just boom, 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 chopping higher, and then wham, dropped off huge. Big range, big bodies of trading were the openings, and big low, big range, boom. Like all these other markets they had, all these other days, some of them had some good ranges, but basically settled unchanged, which means indifference of opinion. Or they were just down real big one day and then back up the next day. They just absorbed the trading over 2 days. So net in any given day or any given 2 days, not really anything had happened for months until boom, here we go, down, rally up. Here is our sell signal. So we're going to put this here. This is our bearish. Oops. I don't know what happened there. I'm going to have to delete that and restart that. Okay, so bearish engulfing. Here we go. Sell signal. Okay. All right, so that's that right there. And then boom, look at what happened. After that close, had you sold it, you would have had no heat. And then look at this. Look at what your risk level was, folks. And this is what's great about these signals, because once they hit, you know exactly what your risk is. This was your risk. You had your sell right here. We're going to put this as a different color. Okay. All right. So you had this bearish engulfing sell signal here in the US dollar Canada. As of that close, after that, you had the opportunity to sell it or even sell it just a little bit higher, and then look at what happened. It never looked back. Your risk, your sell signal was 133.73 with 134.23 being your, or 134.32 being your risk. 60 cents, but look at what happened in that just one day, 132.79. So 132.79, that's a full dollar move. So everything that you were looking to risk, you were gaining in one session's trade off of that sell signal. And then we still had our target here. Now in our methodology with the book, this day right here would have taken it out, and bam, you would have made your money. However, we have our initial targets, and then we have, because you never know, the trend is your friend, and especially in something like this, what happens in a situation like this where you had that lower move low, lower move high, you take out this lower move low, obviously you're going to get some sell stops here and drive this market lower. Why not make more money? So you have your initial targets. In this webinar, we're not getting into calculating targets. We don't have the time for that. That's something you have to read in the book. There's a methodology for that. There's also multiple other methodologies on how to utilize these sell signals. But look at this once again, US dollar Canada. What would this mean to you as a trader? So as an FX trader, obviously you jump on the short side, US dollar Canada, or you sell credit spreads in the futures right here above the market. You could have call spreads right here. It was at 134.5. So I don't know what the strikes are right now, what they would have been here, but what was the high? The high was 134.32. So yeah, if you could have had a 134.50 to 135 call that you, or excuse me, yeah, call that you would have sold, and then bought, like, I would say a call one full dollar above it, you would have taken that credit, and look at this, boom, 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 boom. Within 2 days, you would have, and especially on the third day, it's so far in your favor, you would have been loving life. Now, this was right around expiration too for the currency contracts, so you probably would have been trading. Definitely not the June because there was no more time decay. But if you had definitely jumped on some of the further out months, the time decay would have been slight, but the volatility and especially the move would have, you would have been able to capitalize on that, and that would have been a very low risk trade because you would have had a credit from the start, and then when you would have gotten out of it, and then you would have been a winner right off the bat. So you could have been short the futures, you could have been short the credit spread, or on the futures, or you could have been short the outright forex on this bearish engulfing pattern right here. And instantly, and this is where these patterns are great, folks, because we showed you the Euro US dollar example going to the G20 meeting. Boy, that was rough. It's one of the majors. It's probably why it was so frozen. But with whether it's meetings or not, who knows? You never know what's going to happen. But how about when you actually are disciplined enough to use these signals and exercise a trade? So in this situation, bearish engulfing sell signal in the U.S. dollar Canada, had you exercised the opportunity, you could have either sold the forex currency, U.S. dollar Canada, or you could have sold the future U.S. dollar Canada, or you could have sold the credit spreads above the market, or you could have bought puts, or especially think about this one, folks. This is right around expiration. You would have, if you would have bought out of the money puts for July and August, right when this happened. Boom, in one day, the volatility, this is where you can make money with buying options, because 90% of options expire worthless. But think about this, you're on the right side of the market, volatility kicks up, and you get a full dollar move within one day. On an option position, for a put position, that's huge. One, you get the price movement that all happens in a very short amount of time. Bang, you're a winner. Then you're on the right side because you're long a put in our example. Bam, you're on the right side of the market. Then you have time decay. There's next to no time decay. So boom, that doesn't erode your position. You really, bang, zoom, you can get out of that position right off the bat and say, hey, I only have X amount more of target distance to go, but unless all these other Greeks, and the reason I say Greeks is because anyone that trades options knows that there's different components to option pricing. You can be on the right side of the market, and the position can keep on going in your favor. But with an option, over time, you're going to end up, you're going to reach your point of diminishing returns as far as profitability for return on investment when you're on the right side. And it also works against you, double-edged, actually exponentially in the reverse. So, but for this example right here, look at what we had. We had multiple markets where you could trade this little sell signal, and you could capitalize on that. So that's the U.S. dollar Canada. And now let's go to the NZD U.S. dollar, because this is an interesting one. So lately, while the U.S. dollar has had strength and then started to wane going into the G20 meeting, or at least go sideways with most of your majors and what have you, the New Zealand dollar, U.S. dollar, just seems to not really care. It's a bull, and it says, hey, you know what? We don't care about G20. We don't care about tariff deals and what have you. Oh, but wait a minute. Here we are on Sunday night. So let's get rid of the news here on our chart. Let's get rid of the volume here. So as you can see, there's been quite a rally over the past 2 weeks. So now we have a couple of signals that have transpired here. First of all, we have this one right here, which is going to be our bottom zone here. So in this little area right here, you can see this is a bullish engulfing line right here. And that little bullish engulfing line, it's amazing. Remember how I said, yeah, it's not that these signals will be always be the actual bottom or top of a trend, but it's uncanny how often they are. They really put the brakes on a market where when it happens, and now it can fail, absolutely it can fail. But when they do work, which they do work often, and the odds really are, at least, especially, which is amazing when we were talking about those options trades, you had 1 day movement like that, you could have exercised that trade, put it out the next day, seen such a profit, and said, you know what, I could roll out of this, get flat. If it exploded it back in your face and went back to where you started out with when you first initiated the trade, think about that. You, in 1 day's time, you could have avoided that, done that, made that kind of money. So those opportunities, at least in the short run, definitely, there's a really, really high probable chance of that. Intermediate and longer term remains to be seen on any given market, but typically they do as well. So that being said, here we have this bullish engulfing pattern right here, and then look what happens. Higher move low, lower move, or excuse me, higher move low. Market then, boom, takes out this level right here. So just for illustrative purposes, so you can see this, how this works, boom. Okay, so we had, let's move this over. Here is your bullish engulfing line right there. See, the market kept breaking, and then boom, made a stamp to higher move or lower move low, and then look at that, like a balloon underwater. Next day, wow, looks like profit taking right there though. After an extreme sell-off like this, what bear is not going to be like, hey, this is supposed to happen, let's keep on jumping on board, we're going lower. And look, sells off, and it sells off kind of harsh. This is also kind of a systematic candlestick pattern right here. We're not going to get into that because it's a lesser known pattern. So that being said, lower move high, higher move low, and then we have this kind of doji right here. See how this low is here? It's basically unchanged. That right there is a short-term change in trend signal. So then boom, we get this big, like a balloon underwater rally. Look at this. We had more upside action in 1, 2, 3, 4, 5, 6 days than happened in a month and a half. That is the velocity of momentum that you need to take into consideration. When you get a move like that, you say, hey, no matter what, the overall trend is down, but wow, look at that. That's quite a corrective move higher. And then look at this. Boom, here's a sell signal right here. Bang, zoom, sells off, comes all the way back down near these lows, and it looks like it is the end with this sell off here. And that's where traders, you have to remember, you cannot be emotional. You have to have a plan, you have to have a system. And just to let you know real quick why I mean that in extremes, here we had the bearish engulfing line. This was here, this was a sell signal, been short for a couple days. Look at that. I've been riding this heat. This is my risk, I know where it is. It's been basically neutral to negative for days, when normally this kind of signal within a day or two would put it in or close to this area if it was right, or it would take this out and stop me out. So just draining around and dragging around in this range trade, but because of G20, I looked at it, this is how it is. You know, you got to stick to your guns. This is the system. This is the methodology, like I have in the book, High Probable Japanese Candlestick Patterns. So you stay short. But here it's a very tight range. It's not so severe. Now we go back to our New Zealand dollar, US dollar. Well, it's a totally different story. Look at the size of this break. Bam, slam. And then the next day, you have this little doji that's within there, and that's actually the first, that's kind of a harami is what it is. That's the first indication of a change in trend, or at least a stop of the current trend, which is obviously here, negative and lower. Then we have, boom, this big rally that comes up towards the 50% mark of this big day here where it's sold off. It takes a lot of momentum to drive the market and pound it like it did there. And then the next day digesting and not coming back too much, that makes it still seem like, oof, Look at this. This was a corrective move higher, and wow, we are really set to take out this low that was originally here from this sell or this buy pattern here. Now, this trade here had been already taken out. It was done. So this has nothing to do with this trend here. But then we have this next day here. It's positive. That here is a 3 inside up. You had a breaking market right here, a 3-day pattern. Low day stamps a bottom. Second day, third day, positive. This is the beginning of a buy move. Now, the target for this type of move right here would have been right about in this area right here. It definitely wouldn't have been up to here. Now, you never know. The markets can keep on going and trending in one direction for a while, and a bull can come out of nowhere, a bear can come out of anywhere. You never want to try and pick a bottom or a top. But in this situation, if you look at the volatility, I mean, look at the market have been trending in these tight ranges, and every once in a while a wide range, but just trending lower and lower and lower. Even here, bottoming, but then boom, it escalates, explodes higher, slams it down lower, and then once again, in a 2-week period, phew, bang, zoom. Now this is where I would look to right here. We have a potential forming candlestick pattern right here. So this here, oops, okay, all right, this little spot right here. So we've been railing off of this pattern right here, and we'll put this, okay, so that's a pattern, oops, okay, there we go. All right, so that's a pattern too. All right, so we have the market is railing up into today, and look what happened. We had a higher move high, and the body of this market is coming down into the 50% mark of Friday's trading. This is setting up for a potential dark cloud cover. Now, dark cloud cover is a sell signal. Potential, oops, dark, oops, that's not working right. Okay, let's get this here. Potential dark cloud cover sell signal. Okay. So now this is something to watch, folks. The NZD US dollar has been, while the US dollar has been strong against most of the major currencies, the NZD has been railing against the dollar. Now, not that change in trend in the dollar is going to change the trend in this one right now, because it's been divergent of the other majors. Right now, you've seen definitely a bottom in the New Zealand dollar, US dollar. It's definitely in a intermediate neutral trade and short-term bullish trade. But for the very short-term intraday and short-term daily trade, we have a potential dark cloud cover sell signal. If the market settles about where it's at or lower, it would be either a dark cloud cover or a bearish engulfing sell signal. In which case, then I think you're going to see a corrective move back towards this area down here. So let's give us a couple targets right here. So one would be this area here, and another one would be this recent high right here. So the short-term break should take down, it should test this area. Now, if it's a very strong bull, this is about the extent of where the market will break down to and then rally. I think that it's probably going to take this out and then settle into this area here. So somewhere into, I need a new one, sorry. Didn't make a good ellipse. We're going to erase this and put this right here. Okay. So that is pretty much the area where we're looking for the target to go. So with that being said, do we have any questions so far? We've covered the New Zealand dollar, US dollar. Right here we have the market that's railing up here, a potential dark cloud cover sell signal. That's if it closed right where it is right now, tomorrow or today, or lower would make it a bearish engulfing signal, which would still be a sell signal. And right now, the way this market is setting up, we could be looking for a correction that would target this area right here, which it would be time for no reason to take a little profits, or no reason not to take some profits. So Euro US dollar is where we started. The market is slightly lower, and once again we have it targeting this lower extreme area right here. Then we have the US dollar Canada trade, where we had this bearish sell signal. This was just showing you an example of how to utilize these things. But then we have this right here. I don't know. We will see what happens after today and tomorrow to give us a signal. Right now, the market is in a bear trend. This signal has already been exercised and overdone, so there's no reason to think that this signal has any bearing on anything. But it shows you how, look at this. There was a trending up, lower move low, lower move high, with this sell signal, and then bam, we have a major correction that has ensued over the past month and a half. So that shows how these high probable Japanese candlestick patterns can help you out in your trading, like especially once again in a situation like this. We're just going to do a quick review. US dollar Canada, let's say that you saw the sell signal right here. You could have shorted the Forex currency, the US dollar Canada, or you could have shorted the US dollar Canada futures, and you would have known that your risk level was this current high of 134.32 in the cash, or the relative high in the futures, depending on what that was. And that's another thing where you have to look at in another webinar. We're going to show you the difference between futures and cash, where you may get a sell signal here in the cash. It wasn't there in the futures. That gives you a leg up on getting short the futures, because the cash, whether it's the cash or the futures, wherever the sell signal happens first or buy signal happens, that's where it's at, and that's the leader. So we will look at these things in the future in other webinars and show you the divergence and the different types of signals you can use in multiple markets. Because like I said, with this one, you could be short the futures or the cash, or right here, you could be selling credit spreads above the market. You could be selling calls above this high. You could be buying puts right here, or even out of the money puts that would have definitely, wow, in a move like this, I mean, you're looking at, you put that on after that sell signal, you put those out of the money, the puts, even they would have been right there at your lower ending strike prices, because you wouldn't have been way, way down here. Most likely you would have been a half a buck to a buck away, and you would have right there within one day, within 1 to 2 sessions, been in the money on those out of the money puts that you bought because of this sell signal. And that's the kind of thing you got to think about, folks. I was just giving you a buying options scenario. 90% of options expire worthless. So if you're buying options, you need something like this to give you the edge to know when to buy those options, whether they're puts, calls, or spreads, whatever it is. You need to have something that puts the odds in your favor. You can use whatever your signal system is and methodology is, but when you can use techniques like this, where, let's say for instance, when this bearish engulfing sell signal happened, you're super bullish in whatever it is your algo is, and they're saying no matter what, the US Canadian dollar is going higher and blah blah blah. This would be a situation where you'd be like, okay, we're going to still follow our algo, but maybe we will reduce our downside risk, where you're going to, since this is a sell signal, if your algo is triggering buying, it's going to have certain parameters or cutoffs until the market gets either proves to go higher above this 134.32 level, or it has gotten down to this area where all of a sudden it can justify buying the market versus buying the market up here. And that's where this methodology comes into play in a big way, let's say you have an algo or a system where you're getting majorly bullish. You had this bounce here, and you're like, oh, the market's been railing. This is just a corrective move lower, and this is a great opportunity to buy. This was a great opportunity to buy until this popped up. So, and even if this was, let's say, the market was only going higher, this would be a short-term, maybe corrective area to come down here, but not really. That's not what happened. When you have a signal like this, boom, this occurred. Look at what happened. It not only took out this low, it was 50%. And that's the thing, is the velocity of momentum that occurs off of these buy and sell signals is very, very strong. So unlike the Euro US dollar example like we showed, but that was because of the G20 meeting that we were coming into, in a normal trading environment, you're going to have situations more like this. And these are the things that any trader that is recognizing these things can capitalize off on these things. Like I said, like, you don't have to necessarily be long or short the US dollar, Canadian dollar here. You could be in the futures, you could be in the options, and then there's also all kinds of other different vehicles in which you would capitalize off of these types of signals. So then we had the US dollar Swiss also, where we had the piercing line buy signal. And now we're heading up into this trading range right here, looking for a challenge of 98.54. Now, does this mean that we're in a bull market or setting a major bottom? Who knows? Well, we're definitely not in a bull market because the market's been breaking down for the past few months, definitely the past few weeks. So that's definitely not happening. However, we could be basing, and that's why this is a good little area to look for this to trade into, and then kind of chop around. And if US dollar strength is coming back into the market, boom, we'll get a rally above here, above 98.53, and then I could see us making a challenge of parity or falling short again and trying to trade in this. You see how this little area is here? We move that to here, so you can see it coming up the boom, then kind of chop around here, and then pierce this line, and then just chop, chop, chop below parity, and kind of base. And that would be if US dollar strength really comes into the market, and this is where fundamentals come in. Right now we're looking at just sell signals and buy signals. Right now this one, it's there, and it's coming into the range and getting close to getting capped out. And then lastly, we're going to go back to our Euro US dollar real quick. We have the sell signal here. Today it's trading lower, and we're looking for it to go into this lower range. I think the 113.23 is definitely not out of the realm of possibility within sometime on Monday into Tuesday, and then into Wednesday, probably trading down to this 112.95, 112.69, and that's probably where we're going to see support, and then see it start to kind of basically be neutral and climb up on this rising supporting blue line here. We're coming into the U.S. holiday for the July 4th holiday. Things are going to be kind of tight where everything's opening up now and going into Tuesday and Wednesday afternoon. Then the U.S. market shut down for a day and a half. The rest of the world is kind of on holiday, if you will, for summertime-ish. So I say ish because they're there, but we just had the G20 meeting, so world leaders and all the politicians, they're on vacation, so we know nothing political is going to really happen, if anything but speak. That means nothing, because nothing will be stamped or written down and put into law or into motion. So just remember that any headwinds you get from that, and that's where these patterns are great, because they don't care about the news. They gauge the true value of where money is moving. And that being said, the G20 meeting probably is going to be puffery, and we have summertime, so get ready to use these technical things, because I don't think we're going to have any real success with any geopolitical news for at least the next month and a half to 2 months. And that being said, I hope you've enjoyed this webinar, and if you want to learn more about the candlestick patterns that we talked about, you can read the book High Probable Japanese Candlestick Patterns. It's available on paperback and Kindle on Amazon, and through it you can utilize the best buy and sell patterns used for over 400 years, giving yourself the edge against the markets in the Forex, the futures, the options markets, stock markets, We discuss all kinds of correlative trades where you can be an equities trader or an ETF trader and use moves that happen in the currency markets or the interest rate markets or whatever is related to what you use. Let's say the coffee market has a buy or a sell signal and you're trading Starbucks. It could have an issue with you, especially when you're looking for, are you holding Starbucks, let's say, for the next 6 to 12 months? That could be an issue, you know. So, for instance, just to give you an example real quick as we're closing out this segment, and this is how you can really utilize cross-market analysis with these kinds of signals. Let's say you have a sell signal in coffee, and it's a big bearish engulfing line on the weekly or monthly chart. And for hypothetical reasons here, let's just say the signal is good and it keeps on breaking and breaking and breaking. At the moment of that initial signal, if you were to say buy Starbucks or buy other coffee companies, or especially if they were beaten down, roasters or whatever that are out there in the market, and you're seeing this big monthly or weekly signal and you're looking for a break in the coffee market to last anywhere from 3 weeks to 3 to 6 months, what would that mean for those stocks or whatever? Obviously, their profit margins would begin to get better, not initially, but definitely at that end of that cycle. So during that period, you would look to start to buy down those different stocks. And then as the cycles turn over to 3 to 6 months, and then they start to have, it will show in their earnings that their profit margins are growing because of the fact of reduced coffee prices. They most likely are not reducing prices. This is just a hypothetical example, but I use like Starbucks because I'm not a coffee drinker, but I don't know that they've ever reduced their prices. So with that being said, that would be a situation where you would be able to buy Starbucks and short coffee or sell coffee ETFs, and profit in those different markets in the short run, and then as well as buy into stocks like, say, Starbucks, like 3 to 6 months later, right in front of earnings, expecting them to beat earnings because you know that their costs have been driven down no matter what over that time. So with that being said, I'm Teddy Keckstead. Thank you very much for your time. You have a good day. Use a plan. Find us at www.forex-trading-unlocked all the time, and follow us, and share us on Twitch, please. Thank you.